Welcome back. I know I owe y'all a video on Mastercraft, JAKK Specific, and ATKR, so I wanted to knock those all out at once because it's so much easier now with the website. And once again, the website just launched last week. You can sign up. I tweaked it a little bit to where you don't need an account to view it at first. But then if you want to save stuff to your watch list or take advantage of some of the premium features, you do need an account. And we're offering very special launch pricing and a 14-day free trial. So you can see kind of how it works by watching this video and just check it out. It'll be the links in the pinned comment. All right. So first off, Mastercraft. This is one that just to start with the end first, I think it's a great company, but I think pricing it hasn't really given you a good entry, and maybe that there's been some good exits as well, exit pricing. Okay. So real quick, what do I mean by a great company? So look at this. If you go to the balance sheet here, total debt is, I'm going to put it on quarterly. They've been running at $0 of debt since December 2024. So that's awesome. And one of the reasons I really liked them is because if you go look in their cash flow statement and you look at their free cash flow, and I'll do rolling trailing 12 months because I love the rolling because it smooths out that curve, but you get more data points. They had this huge spike kind of post COVID, even further than that. And what they did with that money was pay down debt and buy shares back. So, making a lot of money is great for a company, but if they don't use it right, if they reinvest in crazy capital expenditures just in time for the market to crash again, that's the worst. What did they do? They bought back shares, they paid debt. They did do some CapEx and some acquisitions, but it's nothing excessive, right? So really like that about the company. On the valuation front, so free cash flow, I'll go here to custom metrics, and this is something you can build your own. If I wanted to do free cash flow per share, I've already done this, but you would search for free cash flow, divide it by the number of shares, and save it. I already have it saved, but I just wanted to show you how you could do that. All right, so free cash flow per share, look how high it got, $6 a share, in 2023. And that's on a stock that's, $23 right now. The tariffs and all the stuff last year and just the recovery from this spike compounded. It was not a good few years, right? But if you think, and I don't think this is a crazy assumption, they're going to be a stronger company than they were before they got rid of all their debt and before they, acquired, I think, MPX or somebody else, right? So, and there's less shares outstanding, right? So it's not a crazy scenario, I would think, that they would get back up to this over $3 a share. Let's call it $3.27. And if you wanted to build that valuation model here, you go to your DCF here and you say, I like to expand this because it shows you that the years, and I like to say, okay, they're at 150 now. If they got back to 330 within 5 years, which I feel like is pretty conservative, what growth rate gets me there? So 10% over the next 5 years gets me to 250. 15% gets me to 314. Okay. Then let's just say that they grow at 1 to 2%. I would never put a super high number here. It's really messes you up. Then you put your discount rate and your margin of safety. And you can see that they're, I have fair value right at what they're selling for now. It's pretty crazy how that works, right? With margin of safety, of 33%, you really need to wait. But that would be in this scenario. If I go back to the cash flow, if they were able to get back up into this, $4 or $5 range, then what does that look like? 22%. So even if I keep the low end where it is, you can see how the distribution shifts, right? And 77% of scenarios with these numbers fall above the current price. And once again, this line is your current price. This line is your current price divided by 1 minus your margin of safety. So just think of it as red is bad, green that's your idea of undervalued, and then the dark green is deep value. All right. And then another cool thing with the site is that you can save these valuations. So I can save, and I'm just gonna call it Mastercraft video update. So I can save that. You can go view these up here, and it works great because it's like a journal entry if you put notes and stuff for whenever you did this, which, I think that's very important. I used to keep a notebook and now I just do this. And, you can come back 6 months later and rerun at the current price, So anyway, Mastercraft is one where I've kind of been following this. If it dips below 20, I'm very eager to add, but I have been trimming above 25-ish, I would say. But that's just how I'm viewing it. Everybody should do their own research. You use the website to do it. Once again, great company. I think that the market has kind of starting to judge them fairly, but if they really break out, I think it's the upside's huge. I mean, there's scenarios where you get close to $40 a share, right? So that's close to double. All right, next up is going to be JAKK Pacific, the toy company. Now, just on the story side of the investment, these tariffs last year hammered them. So if I go to their diluted earnings and look at quarterly, no, that's diluted number of shares, diluted earnings. They really, and I don't do rolling trailing 12 months, but they're really doing great, making $2 to $3 a share, growing $4 a share. And then after that tariff stuff last year just really fell off to where on a rolling trailing 12 months, they're making under $1 a share, right? From balance sheet perspective, they're still strong, right? So just, once again, total debt, $50 million on a market cap of 260. It's not, it's not crazy. I think their debt to equity is pretty good. So that's one of my custom metrics, right? No, but right here, debt to equity. Yeah, I mean, it's 0.21. That's great, right? I love to see that as low as possible. Under 1 is great. Now for evaluation, this one is crazy because if I put free cash flow on a rolling trailing 12 months basis, look at some of these numbers. So remember, the market cap up here is like $268 million. They were making $70, $90 million, a year. If I look at the year, they had 1 year at 75, then 50, and and then last year they really got hammered. They actually had negative free cash flow. One thing I do like about this is if you look at stock-based compensation, they did, you can see that it's, they were high for a while, but it's been negative or zero the last few quarters. I'm sure that has something to do with the options pricing and all that. But one thing you'd hate to see is free cash flow dropping, but stock-based compensation continuing to rise. So anyway, on a value standpoint for them, and this one is where it gets interesting because if I go back to free cash flow and say, okay, they get back up to here, $40 million a share, which I don't think, not a share, $40 million a year, which I don't think is that crazy because they've been focusing on the evergreen business. There's good IP coming out with movies and stuff, and the story seems good, right? $40 million a year divided by the number of shares, which is 11.44. That's about $350 per share in free cash flow. And at the high end, even if you don't get up to 90, which is kind of crazy, but if you get to 60, let's say, 60 divided by 11.44 is 524. So 350 to 524, what would that valuation look like, right? So right now they're at 164. What would they have to grow at to do that? So to get to 250 or to get to 350, you're looking at about a 16% range. And then to get to 524, 26, let's say. So long term, remember, always low there. I mean, this one at that scenario is still really undervalued, assuming that they have this strong growth over the next few years, right? And they could grow faster than that, which helps the math even more. Let's just say that they don't do that good, that they're, that they only grow at 5%, only get to $2 a share. Now you see the distribution changes. I still think that it's a very asymmetric play, right? Because 75% of the scenarios are above 23, which is kind of what it's selling at right now. But I feel like the upside's pretty big. This is one, I feel like it's in a hold zone for me. I'm not adding more at $23 a share. I'm not really trimming. Maybe if it gets closer to this 20, 27, 28, 29, I could see myself maybe doing a little bit there. But I just feel like this one has serious upside potential. if it skyrocketed to, and they were making $5 a share, I mean, you're going to be over here in this range is like what fair value is today if that's what it's going to play out at. So anyway, I'll save this one too. Let's see, JAKK update video. All right. And lastly, ATKR, company that broke my heart. So this one reminds me of Charlie Munger saying that you should kill one of your best ideas every year. And this was my best idea for a long time, and it really let me down. The lesson learned from me was that this number here, free cash flow per share, let's see, free cash flow per share, back whenever we first invested was, 14, and management had said, hey, we will be at $18 a share or higher by 2025. And that was like their benchmark, and everything looked like they were going to get there. There was, I thought they were tied into these data centers and stuff, that they were providing, nuts and bolts for all these build outs, and that it was a great story with, that was undervalued, but that was not the case because they fell from 14 hard. And now they're actually, if I look at the quarterly performance, they've actually had a negative $2 a share one quarter, which was the first negative quarter in free cash flow since 2020. And then even the following one, not even a great recovery, right? Only up to 40 cents a share. I mean, I was expecting this to be $5 a share per quarter whenever I was investing on average. So this one, I was in early, but I pretty much completely round tripped all the gains. I held it up to 200. It says it only got to 183, but I swear it got close to 200 because I remember thinking that I actually had a post about it on YouTube where I really considered selling, but I don't know, just didn't do it. And that's a tough pill to swallow, right? Whenever you're up over 100% on a stock and wind up somehow losing money on it, right? This company, though, I still think there's a price and a scenario that it could be decent for re-entry. It would, I don't know, it would either have to fall significantly for me, or we'd really have to start seeing some free cash flow turnaround. But I don't know if I would be in time, because by the time the free cash flow came around, I think the stock price might jump ahead. But I'm continuing to follow that company. I don't own any now, but they're definitely on my watch list. So, but that's all I have. I hope you appreciated the update. I can do these videos a lot quicker now, so give me some recommendations. Tell me what you want to see. Sign up for the website, try it out. Use this little button here to message me and to tell me what you like, what you don't like. If there's something that's not working properly on the website, do that. And look forward to hearing from you, seeing your recommendations, and have a great weekend.